Hey everyone, welcome to this week's special presentation. My name is Patrick France, Senior Instructor here at VectorVest, and I'm delighted to bring you a special interview with the founder of VectorVest, Dr. Bart DiLiddo. This is the first part of a three-part series, and if you want to see the second and third parts, make sure to head over to the VectorVest YouTube channel, subscribe, and turn on the notification bell so that way you get notified when part 2 and part 3 are released. Also, if you stick around to the very end of today's special presentation, I will show you exactly how to go do that, how to subscribe to the YouTube channel, and how to turn on those notifications as well. So without further ado, let's get into it. My name is Patrick France, Senior Instructor here at VectorVest, and today I've got a very special guest, Dr. Bart DiLiddo, the founder of VectorVest, and also a former Vice President of a Fortune 500 company, also an engineer by trade. So, Dr. DiLiddo, would you like to introduce yourself a little more?
Sure. Hi, Patrick. It's great to be with you today. Uh, I started investing in 1960. I grew up partly during the Great Depression of the 30s. I was born in 1931. And so I had to work for everything I got. Finally, I graduated with my doctorate from a very fine engineering school, and I went to work in a research lab. And the folks there were all interested in the stock market. They were investing and thinking about their future and retirement. And I thought, gee, that'd be a great thing to do. So I read some books. I joined a stock club. I subscribed to newsletters. I thought I did all the things I needed to do to learn how to make money in the stock market. But after 15 years, I hadn't made very much. Now we have to remember that I started in 1960. And for the next 15 years, the Dow only went up about 150 points. It's cycled between going down and going up. There were three uh, bear markets during that period of time, and the Fed was haphazard. There were a lot of difficulties, but the problem was I really didn't understand how to invest, and I wasn't getting the information I needed. So in December of 1974, I sold all the stocks I had, and that was the end of the bear market of 72 and 74. I sold at the very bottom. And so after that period of time, I hadn't made any money, but I didn't lose a lot either because I didn't have a lot to lose. I thought it was done for the market forever when in 1978, I was living in Brecksville, Ohio, which is in the northern part of Ohio, and a storm of the century came through. It was a blizzard, and that happened on a Friday night. And so the next morning when I got up, I saw that the garage door was completely covered with snow, and I couldn't even get out of the house, let alone go anywhere. Nevertheless, it was sort of a good thing for me because I had a job that kept me very busy, so I really could relax that day. Well, it turned out that I still had a subscription to Forbes magazine. And I liked to read Forbes because they were the leaders as far as discussing companies and their management style, and that sort of stuff. So I started reading it. And that issue of Forbes, they analyzed and ranked 500 companies. It was an annual edition. It was a January edition of Forbes. And so I thought, well, I'm going to go through this magazine and pick the 10 best stocks and hold them for a year and see what happens. Well, as I went through it, I began to realize it didn't have the information I wanted. I wanted to know what stocks were worth, how safe they were, and when to buy, sell, or hold. And they didn't have anything like that. They told you about return on equity and stuff like that, but I can get that information anywhere. So I dug through some old files that I had. I had read Ben Graham's book, The Intelligent Investor, and he said that a prudent investor should buy safe, undervalued stocks rising in price. And that's what I wanted to do. But nobody told you what was safe and what wasn't. They didn't tell you whether it was undervalued or overvalued. They think they do, but I'll tell you that, talk about that later. Uh, and of course, they don't tell you when to buy or sell. They tell you to buy, buy, buy. That's their job. Nevertheless, I found an article that I had torn out of Forbes magazine once. And it said the way to value a stock is to compare its earnings yield. And earnings yield is the reciprocal of PE ratio. In other words, if the PE ratio is 20, the earnings yield would be 5%. And you got to compare that to the bond yield of a AAA corporate bond, for example. And if the earnings yield was the same as the bond yield, the earnings, the stock would be fairly valued. If it was way below the bond, it was overvalued. If it was way above the bond, it would be undervalued. So that was a start. So I spent the rest of the day, about half a day, going over that. And I created a formula that was quite simple. And it's in my book, Stock Strategies and Common Sense. And I started calculating all the value of all these stocks in a Dow. And it was pretty simple. Then I realized I had left a lot of things out. For example, the earnings growth rate I thought was important. The profitability, the return on total capital was important. And those factors had to be included. And in my book, Stock Strategy and Common Sense, which I wrote much later, I have those formulas. So by the end of the day, I had a feeling for what stocks were really worth. I, of course, didn't have any feeling on when to buy, sell, or hold. That came later. But that got me started. And I started investing again and using my quick formula, comparing the earnings yield of a stock to the bond yield to start ranking stocks. And I started making money. And I found that when I bought safe, undervalued stocks, the money started coming more and more frequently, and it was easier to make money. So I continued working on what I had started. And Apple came out with their little computer right about that time, period of time. So I bought an Apple computer. I had done some computer programming when I was in college, but that was on an IBM 650. So I hired a guy as a programmer. So he wrote some programs for me. And then I thought, well, I need to know something about when to buy, what to buy, and when to sell. And I developed a timing system for when to buy stocks. And I like to buy rising stocks and rising markets. Now, I'd like to tell you a little bit about the book I wrote. It's called Stock Strategies and common sense. And I was somewhat shocked to learn while I was in the market that what you see and what you hear, what you perceive, is the reality. And you go through life deciding what to do and why to do it based on what you can perceive and what you think. And that's why I put the word common sense in the title. Because if you're stupid, you're going to believe everything you see and hear. Does anybody remember the movie about Pinocchio? Do you remember when Geppetto let Pinocchio go and Pinocchio is walking down the sidewalk and these characters engaged him?
My boy, you are allergic.
Allergic?
Yes, and there is only one cure. A vacation on Pleasure Island.
They took advantage of Pinocchio. And I felt almost like I was a Pinocchio in the stock market when I started. And I believe to this day that the book I wrote is the only book that has the term common sense in the title. Common sense gives you the ability to separate the truth from the fiction. What you see and what you hear may not be the truth, and you got to understand that. And it's very important to understand that if you're going to make money in a stock market. Because the Wall Street wizards are there to sell you stocks, whether they're bad, good, or indifferent. And so they tell you a lot of things that aren't to your advantage. For example, they tell you that price earnings is a measure of value. It's not a measure of value, it's a measure of cost. And that was the one thing I wanted to separate and learn about in the 15 years I traded. I wanted to know what the value was. But I was dealing with price earnings ratios, and price earnings could be high, low, and they always had a reason why they were high, always a reason why they were low. Now, I did learn that you could take the price earnings ratio and divide it by the earnings growth rate as a metric for value. That was a step in the right direction, but it wasn't completely true. There were a lot of exceptions to that. For example, this past year, there are a lot of stocks that went up 200-300%. They don't make any money even. And they soared. They soared because they had a high sales growth rate, but they hadn't started making money yet. Nevertheless, I went on and wrote this book, and I gave it the title Common Sense. In the title, it's called Stock Strategies in Common Sense. And it's the only book on the market regarding stocks, I think, that has the term common sense in the title.
I've actually got a copy of it right here.
Yeah. Patrick, can you call up 11/15 of 2019?
In the
On
VectorVest
VectorVest.
views?
Yeah,
Yep.
there it is.
Yep.
I have an essay entitled Common Sense. The title of the book I wrote is Stock Strategies in Common Sense. You can find it under the Welcome tab of VectorVest. As far as I know, it's the only book on stock investing that refers to common sense. Why was that? It's because the stock mavens on Wall Street want you to buy stocks no matter how bad they are.
I like how you finish this essay with, all I can say is, come on, man, use some common sense.
Yeah. But that's the thing you have to do. You have to learn what the difference between the truth and the fiction.
Mm-hmm.
And it's a hard lesson. And my goal in life is to deliver this message to as many investors as I can. So you would find in VectorVest, everything is backed up by mathematics. Everything we do is based on mathematics. And we have in the VectorVest system, we have over 25 years of data that's documented. It's there for anybody to see. You could see the good, the bad, and the ugly, if there is any ugly. I think there's not very much ugly, and there is a lot of good. But nevertheless, this is the background, and this is what I try to bring. Now, I've just upgraded this book, and it'll be showing up in VectorVest soon. All the results will be dated as of June 30th, 2021. And I dedicate the book to investors, trying to give them the information they need to make smarter, better decisions. So that's sort of a long story for the introduction.
I'm looking forward to seeing the update come out. So today I did have a few questions about, just the markets in general, where we're currently at. And I wanted to get some of your thoughts on the economy as a whole. So jumping right into it, over the years, you talked about perception becomes reality. As you just mentioned a few times earlier in your intro there, it's money goes where money grows, and it's all about the perception of where that money is growing, and that causes, that snowball effect essentially. With the markets at all-time highs and earnings beats having less and less impacts on price increases, as we've seen with the banking industry last quarter, a lot of the moves of earnings seem to already be baked in. Are there any words of wisdom that you have to give new investors on what to pay attention to during this earnings season to be able to identify when perception may start to become the new reality?
Well, your perception is a very personal thing. You have to understand the way the market works and have a perception that is accurate. Now, in VectorVest, we believe, at least I believe, that earnings, interest rates, and inflation is what dictates the market, whether it goes up or down. And we document that in VectorVest. And we talk about it virtually each and every week. We have what we call an investment climate, where we document these factors. And we believe that the market will go up as long as earnings growth is increasing. The market will go down if earnings growth is decreasing. Now, the pandemic last year caused earnings growth to suffer, but it's increasing very rapidly right now. Mm-hmm. Now, yesterday, there was quite a scare in the market because it went down. There's a company, a real estate company in China that a lot of people think is going to go bankrupt. And that company suffered badly, and it went all around the world. All the markets around the world suffered. But VectorVest each and every week covers the subject of earnings growth. We believe that earnings growth is the engine that drives stock prices higher and higher and higher. And I'm happy to say that you can go back in VectorVest. If you subscribe to VectorVest, you can go back 25 years and pick the top 20 stocks ranked by VSD Vector. and give it a quick, what we call a quick test. You can look at the prices of those stocks 25 years ago and look at what they are today. And those stocks are, that portfolio of 20 stocks is virtually certain to be higher than it was 25 years ago. I mean, the system is that powerful. But I'm not here to sell you this the system. I'm trying to make sense to you about how important it is to know what the market works, how it works. But earnings growth is vital. And what happens is that when inflation starts going up, the Federal Reserve usually increases interest rates. Now, Jerome Powell, the current director of the Federal Reserve Board, says, well, inflation is a temporary thing. Well, one thing I learned in over 40 years in the stock market, you cannot make predictions. You should not predict anything. You can have an expectation based on what you see and what you do. And VectorVest does not make predictions. So I won't predict what's going to happen with inflation. But I know this, that historically, when inflation starts going up, it's the result of a shortage of supply of goods and services accompanied by an excess of money. And people have money to spend right now, but they don't have the supply. And you could see it in oil, you could see it in cars, you could see it in the grocery store, you could see it in beef. Inflation right now is, 4.75%.
Yep.
We haven't seen that in years. Why is that happening? Well, there was the pandemic, where a lot of this stopped. But another thing that's happening is people are getting money for not working, getting paid for not working. How do you like that? I wish I grew up in that era, but I didn't. If you wanted something, you had to go work for it.
Mm-hmm.
But people have money to spend, and there are technical problems, like there's a chip shortage, so cars are in short supply. Homes are in short supply. A lot of things are in short supply now. But you can't predict inflation. So when you see the devil of inflation get out of the bottle, it's hard to put the devil back into the bottle. And I guarantee you that one of these days, I said I wasn't going to make a prediction. Here I go. I predicted myself. The Fed's going to raise interest rates. And when it raises interest rates to cool down the growth of inflation, they have a mandate. They have a dual mandate. One is to control monetary stability, and the other is to have full employment. Right now, they don't have monetary stability, and they don't have full employment. There's 10 million jobs open in this country. And it's almost impossible to get anybody to go to work, because the people that aren't going to work are making more money than when they did go to work. It's a crazy situation.
Almost like a self-fulfilling prophecy, almost.
Yes, we got the worst of all things going on. But I wrote an essay in 2007.
Inflation fantasies?
Inflation fantasies. All I want to do here, Patrick, is read the bottom line. You can read the whole thing. But let's go. Here's what I said. What we have here, folks, is the Federal Reserve Board's version of the big lie as promulgated by Adolf Hitler and Goebbels. Make the lie preposterous enough, make it big enough, and repeat it often enough, and, quote, the thick-headed numbskulls, unquote, will believe it. And there's another case of perception is reality.
Mm-hmm.
Indeed, stock traders swallowed the spin and stock prices took off. Even if you're offended by Wall Street antics, forget about it. It's more profitable to fly on the wings of inflation fantasies. In other words, that last sentence means you got to let the trend be your friend. Okay?
It's a common saying we have here at VectorVest.
Let the trend be your friend. And these are things that we try to teach to investors. So I can go on and on, Patrick. Do you have any other questions?
Yeah. So talking about the essays, I have an essay that probably my favorite essay I've read over the years of actually being here. Obviously I've read more than that since my father used VectorVest well before I started working here. But all the way in 2019, I have to scroll up quite a ways. October 4th of 2019, you wrote an essay about the modern monetary theory. One of the most fascinating articles or essays I've probably read because, being an economics major, I find this type of topic very fascinating. The modern monetary theory believes that it's as long as aggregate demand doesn't outstrip real goods and services available for purchase, then inflation should be a non-factor. In the modern monetary framework, how do you see the effects of lockdowns and stimulus playing a role on the markets over the next year or 2 years? Because that seems to be, especially with all the moves that the Fed has made, that Congress. Hopefully you enjoyed today's special interview with our founder once again, Dr. Bart DiLiddo. And if you want to see parts 2 and part 3 and not familiar with YouTube, just go to youtube.com, as you can see here in the address bar at the top. Once you're on YouTube, just search for VectorVest in the YouTube search bar. You'll just simply click on the red subscribe button to the right, and then click on that little notification bell to get notified when part 2 and part 3 are released. So once again, thank you for tuning in tonight, and have a great weekend.